Okay, so the rules of global tax are changing, and believe me, it's a much bigger deal than it sounds. We're about to dive into the 2025 OECD update. This is a massive, behind the scenes shift that's going to impact everyone from the biggest multinational companies to, well, maybe even you. Let's get right into it.
And yeah, let's make this personal right away. If you're one of the millions of people working remotely, have you ever stopped to wonder, could my home office actually create a tax bill for my company in a totally different country? It's a simple question, right? But the answer just got a whole lot clearer and a little more complicated.
All right, first things first, the Global Tax Rulebook. To really get why these changes are so important, we have to understand the system they're changing.
So think of the OECD Model Tax Convention as the master blueprint for all things international tax. It's the instruction manual that over 3,000 different tax treaties are built on. Its main job? To prevent something called double taxation. Basically, it makes sure your income doesn't get taxed once where it's earned, and then again where your company is based. This thing is what keeps global trade running smoothly and predictably. But here's the problem. That rulebook was written for a totally different world. A world before widespread digitalization, before crazy complex global supply chains, and definitely before massive-scale remote work. All of that has put a huge strain on these old-school rules. So this 2025 update, it's the rulebook literally racing to catch up with the way we live and work right now. Next up, your home, your office. Let's tackle the issue that's probably on a lot of your minds. What do these new rules mean for remote work? You know, the old reality was pretty simple. A company had a taxable presence in a country, what the pros call a permanent establishment, if it had a physical building there. An office, a factory, you get the idea. But what happens when your team is scattered all over the globe, working from their kitchen tables? Yeah, the old rules just don't cut it anymore.
Which brings us to the million-dollar question that the OECD is trying to answer. At what exact point does an employee's home office stop being just their private space and start being a taxable footprint for their employer? For years, this has been a huge gray area, causing major headaches for companies and employees.
And here it is, the magic number that brings some desperately needed clarity. The new guidance basically says that if an employee works from home in another country for less than 50% of their total working time, that home is generally not considered the company's place of business. This is a huge, huge step in creating a clear, predictable line.
But wait, it's not just about the clock. The update actually gives us a two-step test. Step 1, you've got to cross that 50% threshold. But then comes step 2, and this is crucial. There also has to be a commercial reason for the employee to be in that specific country. Just wanting to live there isn't enough.
So what in the world counts as a commercial reason? Well, they're pretty specific. It means there's a real, actual business need for you to be physically present, like you're there to meet local clients, or maybe you're covering a different time zone. What it's not for is just so the company can hang on to a good employee or to save a few bucks on office space. So that's the home office situation. Now let's zoom out and move on to an even bigger challenge, chasing corporate profits, and how these rules are trying to make taxing giant multinational corporations a bit more fair. The old system had this big loophole. A company could come in, run an incredibly profitable but short-term project, think offshore oil drilling or building a massive pipeline, and because there wasn't a permanent physical location, they could often avoid creating a taxable presence altogether. The 2025 update introduces a new optional rule that countries can choose to use. It creates that taxable footprint based on how long the activity itself is happening, giving resource-rich countries a way to finally get their fair share. But establishing that a company has a taxable footprint in a country is really just step 1. The next and much trickier question is, how much profit should actually be taxed there? And that takes us into the super complex world of how different parts of the same global company do business with each other. The official term is transfer pricing. I know, it sounds really technical, but the concept is actually pretty straightforward. Imagine a company designs a smartphone in the US, builds it in China, and markets it from an office in Ireland. The question is, how much does the Chinese factory charge the Irish marketing office for each phone? Setting that price, that is transfer pricing, and it has massive tax implications.
The core principle that governs all of this is called the arm's length principle. Just like it says here, the idea is that all of a company's internal deals have to be priced as if they were happening between two completely unrelated companies.
total strangers. This is to stop companies from setting artificially low prices to move their profits to countries with super low taxes. The 2025 update really doubles down on this, giving much more guidance on how to make it work in today's economy.
Okay, next up, we have what I like to call some crucial plumbing fixes. These are the technical tweaks designed to make the whole global system just work better, and hopefully prevent arguments between countries.
There are two big fixes here worth pointing out. First, the update makes it crystal clear that if there's ever a conflict, tax treaties will now always override trade agreements. This closes a pretty significant legal loophole. And second, it expands how tax authorities can use the data they share with each other, making it easier to spot tax evasion and work together on big international cases. These might seem like tiny details, but they're absolutely vital for making the whole system work.
So after all that, what's the big picture? When we boil it all down, what should we really take away from all these changes to the global tax rulebook?
It really comes down to three big things. First, we get more certainty. There are finally clearer rules for employers and employees in this new remote-first world. Second, there's a real push for more fairness, making sure countries get to tax the money that's generated from their own natural resources. And third, we get better tools for cooperation, making the entire global system stronger and more transparent.
But the most crucial point to remember is this. This rulebook isn't set in stone. It's a living document. This 2025 update is a huge leap forward, for sure, but it's just one part of a process that's always happening. As our world and our economy keep changing, you can bet this rulebook will have to keep changing right along with it.
And that really leaves us with one final big question to chew on. We're trying to apply tax rules that are fundamentally based on physical location to an economy that is becoming more and more digital and borderless every single day. In a world like that, can these kinds of rules ever really stop playing catch-up? It's something to think about. Thanks for tuning in.